Hey everybody, back with another video, and today we're going to start a little something new in that we're going to actually go into a deep valuation analysis of a stock. And I thought, what better to start with than the value stock of value stocks, Tesla. Tesla is, of course, probably the most talked about ticker you can find on Reddit, on other message boards, on Twitter, stuff like that. So we're going to take a peek and see if it really is the deep value with the exponential growth that people assume it is. We'll start with just looking at some of the numbers. Currently, its PE sits at around 200, 191 at the moment, but, you know, discounting today, the last couple days, it would be about 200. Rise and fall, so we'll say about 190 to 200 just to be, you know, in the ballpark. And its price to free cash flow currently sits at about 100. For comparison, the S&P 500, which is a gauge of the wide United States large cap market, has an average historical PE of about 15 to 16, and a current PE of about 25. Looking back at that historical average, you'll hear a lot of people say, you don't understand, that was the old days, stocks don't work that way now. Okay, let's take that into consideration. Let's just say, you know, the last, I don't know, 50, 60, 70 years. That gives our PE average up to about 20. Okay, so we'll use 20 as a baseline. You do have to look back into history at some point. You can't just look at the past 2 or 3 years. Things don't change that much that quickly. So we'll say 20 as a baseline. That means that for Tesla to be valued at the average of the market over the last, say, half century, it would have to do about 10 times the earnings it has now to drop that PE down from about 200 to 20. On the free cash flow side, it would have to generate about 5 times as much free cash flow now to drop that price to free cash flow down to right around that 20. And over time, free cash flow and earnings should about equal out, so that's why we use that 20 number there. Now, a lot of people are going to go out there and say, well, you know, it's going to grow by that much. Okay, what's the time frame for that? Is it going to be in 2 years? Are they going to do 10 times their profit in 2 years? Or is that going to be 5 years, or 10 years, or 20 years? Regardless, even if it does eventually make it to that point, you aren't getting a deal. You aren't getting the value because you're paying for that price today. If you say, oh, well, it's going to be valued at that much at that point, okay, it's going to be valued at that, but you're already paying that multiple today. If for you to make a return, for the market to return that much for you, in this case with Tesla, it would have to increase by that amount again in that amount of time for you to get any sort of return. You're paying for your future earnings today, and in this case you're paying about 10 times more than the average historically over the last 50, 60 years. If that sounds like a good deal to you, there you go. But for most investors, that's going to sound like quite the red flag. For comparison, let's look at another car maker. And if you think Tesla isn't a car maker, please leave the video. I don't want you to view my stuff. We'll take GM, for example, as they do better than most other car makers in the U.S. They do better than Ford currently. They do better than a lot of the smaller automakers as well. GM currently does in a quarter what Tesla does in a year in terms of earnings, while being valued at 1/40th of the PE. I want you to take that into consideration for a second. What it takes Tesla 12 months to do in earnings, GM does in 3 months, and GM is valued at 40 times less than what Tesla is. GM is essentially meaning GM is doing 4 times the earnings while doing about 1/40th of the PE value. That gives you about that would, if you really extrapolated that out, it's about 1/160th the valuation of what Tesla is moving forward based on what people think projections are. Just keep that in mind. A company that has been around forever essentially is valued that much lower than a company that's been around for 20-something years at this point, maybe not even, I don't know the exact date, and has only turned a profit in the last 2 years thanks to government tax breaks. Again, if that sounds like a better deal for you, go for it. I'm not going to tell you not to invest in this, not to trade this. I just want to tell you what the factors are that lead into the valuation. Going over that things, remember that Tesla does get an amazing amount of tax breaks. That isn't to say that other car makers don't, but Tesla runs on those tax breaks. Its first profits were completely dependent upon those tax breaks. Without them, they still would have been in the negative. The other thing to remember is that this is a political investment. It is a trendy investment. People are buying this because they just see it going up and they hear people talking about its future. They don't actually look into the technology. They don't look into the company. They say, say, oh my God, this is associated with Bitcoin. I have to get this because to the moon. If that's how you're investing, you're not really investing. You could throw a dart at a board and you do about the same in terms of your returns. One thing to keep in mind is that it is starting to come out that Tesla's technology, its battery tech, its clean tech, isn't clean at all. A Tesla battery produces more waste than a comparable combustion engine over the same lifetime period. Lithium-ion batteries are incredibly toxic to the environment. They are not recycled. When people say they're recycled, they're lying to you. They're tossed in landfills or they're tossed in the ocean. Car emissions do not damage the environment to any degree what lithium-ion batteries, especially giant car batteries, do. So keep that in mind. You can call it a hoax. It's the truth. You can look it up. Do it. It's just what is. The other thing to realize is that Tesla is not the electric car brand anymore. It has competitors. Of course, there are scam competitors like the Gravity truck that was pushed down a hill but was still somehow an electric car. But then you also have other brands, Chinese brands like NIO, for example, other American brands that are popping up, it seems like, every month. And then, of course, you have the legacy brands like GM, like Ford, that are starting to produce electric vehicles. For example, the electric Chevy Silverado sold out of pre-orders within a couple minutes when it was announced that it could be pre-ordered. So they're going to start losing market share if I am not under the guise that there won't be more electric vehicles. That's going to happen just because there are people who are dumb enough to buy them. But that means that if there's more market, then other places are going to start moving into that market share. Things like Ford, things like Chevy, GM, things like other startup companies are going to start eating into that market. It's just going to happen, and Tesla isn't the hot thing anymore. When there's a market downturn or something, and then another company pops up doing electric vehicles, are people going to care about Tesla, or are they going to care about that new company? These are things you have to keep in mind. Again, this valuation is based on projections out to, I would have to assume, if you think they're going to 10 times their earnings, you'd have to say at least 5 years. So you're paying, say, for 5 years of value, you're paying for 5 years of value today, but you're still going to have that same valuation, and you would still need to exponentially increase the same amount over the next 5 years. This is not value. Honestly, it's not even a growth stock. The only reason people say it's a growth stock is because of the chart. Its actual growth is at best. From a valuation standpoint, it's a joke, to put it very lightly. Anything more than that, yeah. If you're into Tesla, dude, you can buy it, you can trade it. I'm not going to stop you. It's your money. But just keep in mind how ridiculous this valuation is, the things that have to fall in line over and over again, and the fact that it has competitors now that are possibly making better product than it is and are springing up constantly in a market that is starting to come to light how much of a lie and how much of a grift it's been. As always, thank you for watching, and I will see you next time.